Again, good afternoon, all. My name is Justin Fitzpatrick, and I serve as the United Partners for Human Services Membership and Communications Manager. And I'm joined by our Director for Strategic Initiatives, LaShawn Gordon. And we are so happy to have you all here this afternoon with us with another great workshop that we have here for you this afternoon. This will really focus on nonprofit financial policies and understanding financial statements. As each of you run your organizations, and being that we've just come out of tax season, we want to make sure that we give you a refresher on some things as we're leading into the new year or the new start of a fiscal year, if your calendar runs from June to or July to June. So without further ado, I'll go ahead and pass the microphone off to Ben Clark, the Senior Manager of James Moore & Co. Tallahassee.
All right, thanks, Justin. So hopefully everybody can see my screen as far as this goes. So yeah, we are out of tax season. Luckily, I don't have to deal with taxes anymore. I did that in the start of my career, and now I work in the audit department. So a lot of what I do is work with our auditors, who you may have audits yourself at your nonprofits, but I'm one of the audit managers who helps, kind of oversee audit engagements for the firm. And I spend about half my year working with nonprofits, and so the other half of my year I work with some of our government clients. So like I said before, I want to make this interactive. So if you have questions as we go along, please stop me, ask them in the chat. I think Justin's monitoring the chat if you don't feel comfortable talking out loud, and we can kind of go from that standpoint. And I may have questions for you along the way. We'll see. All right, so this is a picture of me. You can always see me in the thing, but things to know about me. I have 3 kids, 1 on the way. So LaShawn told me that 3 wasn't enough. I should get 1 more kid. And so I have 1 on the way. It's due in September. We're pretty excited about that. That might be the last one because I think we're at our wits' end as far as what we can handle. Other things to know about me: I serve on the board for American Lamplighters, great organization, and with Leadership Tallahassee Class 40 here in Tallahassee. So I did start with the firm back in 2015. It's the only firm I've been with, and hopefully it's the only firm I'll ever be with as far as CPA firms go. So nonprofits, obviously you guys all work for, or most likely work for, a nonprofit. So just kind of reminding some things that I feel passionate about. The role of nonprofits in our society is obviously super important. So obviously there's for-profit corporations that serve a purpose, but there's also nonprofit corporations that serve equally vital kind of purpose. And so some of the things that our members, as nonprofits, what are we doing every day? We're meeting the basic needs. We're helping with social change, educating people. We're even stimulating economic growth in a lot of ways, and also providing innovation. So that's just kind of to frame our discussion today, to remind you, like, hey, what we're doing matters. And because it matters so much, we got to make sure that we're governing the organization in a financially prudent way, and that we're kind of overseeing the organization to make sure that things are being done well at the nonprofit. So that's just kind of my overall statement to say, hey, nonprofits are important. They really do matter to our overall kind of economy and society and how we do everything. And so making sure we're kind of doing the things we talk about today, and knowing how they run is equally important to help make sure that they continue on. So when I kind of framing the discussion around to go a little deeper, how do we keep our nonprofit healthy? A lot of what we want to talk about today is, when I was talking with Justin, I was like, hey, like, what do you want me to talk about? What can I help with? What do your members need? And he said, hey, like, a lot of the stuff they're asking about is stuff to do with like financial policies, right? And, kind of understanding of their overall nonprofit financials and some of the important things there. I said, okay, we can do that. So a lot of what we're going to talk about in frame of discussion on today is just about the financial policies of nonprofits, and hopefully can answer some of your questions there if you have any, as well as just an overall understanding of how the financial process works with nonprofits and how do we understand the financial reporting for nonprofits. So those are kind of probably the overall themes for the presentation as a whole. So as far as nonprofits and knowing that they are so critical, what do we do? And when I say we, I mean really the management and conjunction with the board. What do we do to make sure that they are run well and then they're not shutting down, and so on and so forth? So kind of the first bullet point there says corporate governance. And so when I think about corporate governance for a nonprofit, I really think about the board, right? And so having a board, and that could probably be its whole separate conversation, a whole separate presentation. I know LaShawn's done presentations on boards and what do you want on a board and all these kind of things, but making sure that the nonprofit that you're representing has a healthy and functioning board is just as critical as anything we're going to talk about today. So that's just something to keep in mind for another topic. But as far as the board goes, the board is responsible for governing the whole organization. So the board hires an executive director. They work with that executive director to make sure that the mission and the policies and the overall nonprofit is carrying out everything it's supposed to. So that's kind of the corporate governance. But also the corporate governance involves everything about the policies of the organization. So policies and procedures under that not just includes financial policies, it also includes all the policies of the organization. So are your HR policies up to date? Are your every other policy you have, are your employee handbooks up to date? Everything kind of in line with that is also kind of under everything I think about when I think about policies and procedures. The next thing I think about how do we keep our nonprofit healthy is sound financial management. And so when I think about that, I think of, and this is probably one of the bigger areas I've seen over the past 2 years or so. A lot of our clients struggle is really the sound financial management. So really, I hate to use the COVID excuse, but it seems like coming out of COVID, it's been really hard for nonprofits and really not just nonprofits, but for all organizations, even a lot of my government clients, for them to find good bookkeepers or, even sometimes it's hard for them to find outsourced accountants. It seems to be like this is a great need in our society that we just don't have good help in that area. I think after COVID, a lot of people retired and other things happened where there's just not it's hard to find help in this kind of area. And so really you got to think about for financial management, who is kind of keeping track of things, that organization, who's our bookkeeper and how is that going? And then also kind of thinking about, and we'll talk about this later, is thinking about, okay, well, if that person were to leave our organization, how are we planning for the succession of that to make sure that we don't have a problem? Because a lot of times what happens is you have a great person and then they leave and then you are like it's a giant mess. Everything kind of goes crazy and goes haywire. And every problem. So there's really a lot of like succession planning within even that role within your nonprofit to make sure that you kind of don't get yourself in a hard place there. The other two things here, fundraising. So this could probably be a whole separate topic as well. But another way to keep our nonprofits healthy is to remember that fundraising is vitally important. And when I say fundraising, I don't just mean like putting on a golf tournament or anything of that nature. While those things are good, and there's nothing wrong with doing a fundraiser, it's really good to kind of get the executive directors and the CFOs of a lot of our nonprofits to kind of think outside the box and say, hey, what do grants do? Grants help drive our mission and help us implement programs, and there's nothing wrong with grants. Obviously, grants are a fantastic thing. But really, what an overall long term healthy nonprofit will have is unrestricted contributions and dollars that they can use for whatever purpose they need to. So it's really being able to find those revenue sources that are totally unrestricted, that you can totally use them for whatever you need to drive your mission home. So fundraising is a key aspect of that, and it takes a lot of kind of strategic thought to figure out what are the best ways to pull in a lot of that unrestricted revenue. So those are things to kind of consider as well. And the last one on there is impact measurement. So this is probably a little unusual, but I think it's good in helping fundraising as well, because if you don't know what your impact is, it's hard to communicate with your donors as far as what you're doing. So how can you quantify or measure what your impact is to society, to your local area, and et cetera, to say like, hey, we're doing X, Y, Z, and here's the, if you're housing homeless people, it's like, okay, we've housed this many homeless people. Here's our impact, or whatever the case may be. Impact measurement is a good way to kind of take that and communicate that to all of your potential donors. So does anybody have any thoughts on that before I go forward, or what are we thinking so far? Any questions come to mind? All right, I'm gonna start quizzing you guys if it gets too quiet in here, because I don't like talking to myself. I get kind of bored, or I feel like a crazy person. All right, so we're gonna go on. So updating financial policies. So as far as the financial policies go, I will, let's see who I know on this. Oh, I see Anita on the call. Let's do that. So Anita, at Kids Inc., when is the last time that you've updated your policies and procedures for your finance department? And watch, Anita's gonna say she did it like yesterday because she's really on top of things. So when's the last time you did your
I
updated
literally
your
did
account?
it yesterday.
She did it yesterday. Can you believe this? Oh my goodness. Um,
I did, yes. So it's actually one of the questions I was gonna have for you at the end, but I can ask you now. And hello, everyone. I'm Anita Bushnikova, CFO of Kids Incorporated of the Big Bend. We did have a board meeting yesterday and voted on updated policies, and that was particularly because of our investments. We have decided to invest a portion of our reserves, and we wanted to have the corresponding policy to go along with that. That discussed the type of investments, identified them, delegated authority, and then spoke to what percent of our reserves can be invested. So one of the questions I was going to ask you, Ben, is if there is an industry best practice of a percentage or a dollar amount of a nonprofit's reserves that can or should be invested at any given time.
I think I'd probably have to look that up, Anita, to be honest with you, to see like what our nonprofit standards are for investing a portion of your reserves. I don't think that's not a normal question, and the reason it's not a normal question is I have trouble sometimes even getting my nonprofits to have reserves, to be honest with you. So even getting to the point where we have a reserve base is probably the first goal. So the fact that you're even able to invest some of that, I'd say makes you actually a little unusual, but you should be super thankful for that because that's highly I feel like it's highly unusual, which is awesome though that you're able to kind of do that. But I'll look that up and see how much of the reserves make sense to kind of invest or what a recommendation for that would be.
Thank you. That would be great. But yeah, it was our investment policy, but we do over the summer is usually the time when we do it. It just makes sense for us, but every organization, of course, has different timelines depending on the line of services that you provide. Things slowed down for us a little bit over the summer, so that's when we look at all of our policies and procedures and we update them. But that one was just one that needed to be updated yesterday.
Yeah, so the reason I asked that question is oftentimes, like, one of the standard things like we ask for when we're kind of doing our audits of nonprofits is we say, hey, give us your, accounting policies and procedures. That's like, standard audit request list kind of item baked in. Oftentimes when we get that, it'll say like a date that's like 5 or 10 years ago. Okay, so what that kind of tells me as the auditor is that the organization is not going through a process to update their policies. And then even more so than that, that leads to kind of the other questions that I have here. So if those are 5 or 10 years old, does that mean that those policies even represent the actual practices in place at the organization? Because really the policies need to represent the practices in place to kind of oversee the financials as a whole. And so the reason why we do that is because we want to make sure there's strong internal controls. So we don't want money to get legs and walk off. That would be bad. We don't want money to, be kind of accounted for or anything of the sort. So if we make sure we have these policies and procedures in place and make sure that they actually represent what's actually happening, then we're in a place where we can kind of analyze what's actually happening and figure out where the weaknesses are. So that kind of comes to that last point where I said SWOT analysis. So if you have accurate policies and procedures in place, really the management and then in conjunction with the board, really the board can play a cool role in this is saying, hey, what is a weakness in these kind of policies? Is there anything that's not happening that needs to be happening? And kind of getting the board's buy-in to kind of overview that. So I think the thing that goes wrong sometimes here that I've seen a time or two is it's almost like management will try to delegate creating the financial policies to the board or something of the sort. Really, management needs to be kind of coming up with creating and drafting a set of the policies and then providing them to the board to say, here's what the policies are in place, here's what we're doing, and here's kind of how we do things. And then the board can kind of play a role in overseeing that and making recommendations for change and things of that nature. So that's kind of I would say the best practice there, if that makes any sense. So the other question that kind of comes up too, and I kind of alluded to this a little bit already, is how often should we update the policies and procedures? And I would just say at a minimum, just once a year, if not, at least every other year, if not once a year, is probably what I would say is pretty current. And the main thing being, hey, like I said before, you want to make sure it's accurate to what is actually happening. That way you kind of have everything documented and you're kind of updating. If you just update it on an as you go basis too, that probably makes it even easier than doing these mass updates every couple of years. But the biggest thing is making sure that they're being monitored after they're being created. All right, there might be questions on financial policies and procedures and things like that. If not, we're going to go into some other areas, budgeting and some other things like that financially that we often get questions about. Okay. All right, so everybody's homework is to make sure all your policies are updated, especially if they're like 5 years old. So everybody has homework today, except Anita, she already did hers. All right, so as far as financial stability goes, this is usually where we talk about budgets and things like that. So I will say, as far as the budget goes, some nonprofits I've seen like don't budget very often, or they do a budget like once a year, but then they never update it. So the idea with the budget, it's kind of like your personal budget. You really want to be doing that obviously at the beginning of the fiscal year or a little before, kind of know where you are going into it, and then as you kind of go throughout the year, you can amend that budget. So the board really is responsible for amending that budget, and with the help of management, see if the CFO team and all that kind of stuff. So if we can have the budget amended to reflect what's actually kind of happening in the organization as you go, it's going to give you a better picture of where you're going, and that way you know if you're getting off track or not. The other thing is to make sure that you're sticking to the budget. So financial stability is not just about like receiving donations. It's also affected by your operations. So you got to think of how well are you budgeting? Are you sticking to that budget? Are you wasting money? Do you have strong internal controls? These are all things you have to kind of think about as far as you go along here. The last question about how strong are your financial controls, that's pretty important too, because fraud is particularly high right now given the federal and state aid being distributed. So if you're not properly overseeing that on your processes, then your nonprofit is going to be vulnerable. And so the last thing we want at a nonprofit is like front page news. That's never a good thing usually, unless it's like good news, but usually it's bad news. It seems to be more often than not. So you don't want to have a fraud happen in your organization. So making sure that your financial controls are strong are good is one way to kind of prevent that. And if you don't know whether they're strong or not, I'd say like when you have your normal audit, if you're used to having an audit, kind of working with your auditor to make sure that, hey, are there any weaknesses that they're seeing that you need to address and things like that. I always kind of tell people you shouldn't like fear your auditor. They should be like, your auditor should be your friend. So they should be someone who's kind of coming in, not only placing an opinion on your financial statements, but they really should be working kind of side by side with you to make sure that you feel like everything is going well with the organization, and they really should be consulting with you along the way to make sure everything is going well. So make sure that that relationship is strong with whoever you're using, and make sure that you feel good about your financial controls in general. All right, so the other thing that comes up is for the board, what should the board be getting as far as monthly financial information? And so usually what we recommend as boards, and it was interesting, a board I was on, we actually had to work pretty hard to get kind of information that was like this, and we're just at the point where we're kind of getting that information. But things that the board should always be able to see, and you really, the other thing too is as a board member, you should not be getting this information like the day of the board meeting. If you're getting it the day of the board meeting, it's probably a sign that things aren't operating very timely. You should be providing this to your board members a couple of days in advance, if not more. So the statement of financial position, that's the organization's balance sheet. So you should be giving your board members a statement of financial position as close to real time as possible. And that way they know, hey, here's how things are looking financially. Here's where we're kind of going with that. Your board should also be getting an income statement, a statement of activities. They should also be getting that because that's going to let them know revenue and expense wise how things are looking. Is the organization massively losing money, or are there any other red flags that they see from a board standpoint that need to be addressed at that stage? Budget to actual for the entity as a whole. That's really important. Obviously, you kind of created the budget, so you don't go through this whole exercise to create a budget just to kind of leave it on the shelf. So the idea with the budget is you kind of use that to craft where you want to spend money, where you think your revenue should be, and all these other things. And you want to really monitor how that's going, and if you need to change things along the way. And the other little caveat of that, and this is probably one of my favorites, is the budget to actual by grant. And sometimes it can be a little harder to get a report that goes well like this, but the budget actual by grant will show you, grant revenue and grant expenses by grant. That way you can see if you're over expending on a different grant. That's really helpful to know, because if you have a grant, if you have $100,000 of grant revenue for a grant, but you're spending 150,000 and you're only going to get 100, well, now you have to make up $50,000 somewhere else, and that can be really painful for a lot of places. So making sure that you're spending your grant revenue in accordance with the grant budget and things like that is really critical. So this, the last two things here, aged AR listings and payable reports. Sometimes for certain accounting systems can be a little bit challenging to get this, but for QuickBooks or MIP or I think even Sage is pretty good too. They should be able to run these kind of reports. So we see a lot of times for our nonprofits, they're heavily reliant on cost reimbursement grants. And so the problem that causes is they have to spend the money before they get the money. And so there's a cash flow issue there. So it's not that they're not going to, maybe they won't lose money overall, but they have to spend 100,000 before they get 100,000. It's that type of matter. And so really what you have to do to avoid issues on that is, number one, have a reserve that helps you float some cash until you get a payment. And then the second thing is make sure you're getting paid timely. And so we see with some grants, you forgot to check a box somewhere in your invoice, reimbursement request or something kind of silly like that. And the next thing you know, it's 3 months later and you still haven't gotten paid. And so you really got to kind of be on top of monitoring when the payment's coming in and staying on top of that to make sure that you don't have large amounts of receivables standing out there. The other thing too is, as a board member, you should be monitoring, and really I guess as management too, but as a board member, you really should be monitoring your accounts payable. And so if I'm a board member and I receive an accounts payable report and I see that we're 90 days overdue on a lot of invoices and we haven't paid our bills for, and they're 90 days overdue, I'm going to probably start questioning that and asking, the CFO, the executive director, kind of what's going on with that to make sure that there's not an issue kind of to be addressed, because that would be a major red flag. And then the last one there is just cash projections of where you think the cash is going to land. Those are always helpful too for board members to kind of know if there's a cash, balance, if there's a cash on hand issue, if there's anything that need to be concerned with there. So I'm going to pause there and see what, if any, questions you guys have on that topic, as far as things that you should be providing to your board ahead of board meetings.
Ben, I see it is a question from Miss Karen in the chat.
Yeah.
I don't know if you want to get that one later or not.
Yeah, you want to read it to me?
It says, what are the minimum subjects financial policy should cover?
So without being totally vague, I think it should be everything. The way I imagine it is your financial policies are kind of a narrative of how the finances of the operations runs. For instance, how are bills paid? How is money received? Who's receiving the money? Who's signing checks? How, on the check disbursements, is there a threshold where you have to have 2 signatures? How is money being invested? What is the money allowed to be invested in? I mean, it's any and everything that has to do with how the whole finance department runs, and then what are the controls in place kind of for those for that department, if that makes any sense. So hopefully that answers questions. So without saying everything, it's kind of like, I almost imagine it as like a narrative of the finance department, the accounting department as a whole for the nonprofit, and then what controls are in place in various places.
Ms. Karen said, thank you.
Okay.
Ben, I have a question on this financial information. Obviously provided at board meetings, most of us aren't meeting monthly. Is your counsel to send this monthly or quarterly in between board meetings, or what's the best practice there?
I mean, I'd say it's probably up to, that's probably a conversation to have the board chair to see what they prefer as far as the information they need. I think monthly is fantastic. If you can get that information monthly, even if you're not meeting monthly, to kind of send it to them, that's great. But if the board chair says, hey, quarterly is fine, as long as we know everything's kind of going fine, there's no issues, and I can do it quarterly, that's probably fine too. So I think it could probably go either way. The fact that quarterly probably the minimum recommendation. So that's probably my answer there.
Thank you.
All right, going on a little bit here. So budgeting. Budgeting is a big topic for nonprofits. Obviously, they want to make sure they're staying within their budget. The biggest thing with the budget, and this is why we have like two main points here, is often we get the question, I'm a nonprofit, I shouldn't be making money. And that's like a myth we have to dispel, right? Like a nonprofit is a business, just like any other business, and the goal is actually to make money. The difference is in a for-profit business, where do the profits go? The profits in a for-profit business go to what? The shareholders, right? They go to return on them and they pay the shareholders back. In a nonprofit, the profits go into the organization to use for the overall mission and to drive the mission forward. So think of the for-profit entity as going out the door to the shareholders of the for-profit. We're making money, ideally, to run back into the overall nonprofit to drive its mission forward. So on that same note, when we talk about budgeting, one recommendation we have when you're budgeting every year is to budget for net income. And so you budget for revenues of a certain threshold and you budget for expenses of a certain threshold, but you actually budget to make money. And then you can decide what you're going to do with the money that you make. Will you add it to reserves, or will you use it to maybe buy a piece of equipment that you need, things of this nature? You can do things like that, but making sure you're trying to make money every year, and even set money aside if possible, is a great goal to have kind of for the board. So remember, you don't have to pay taxes on obviously the money you make, so that's a big advantage to for-profit corporations. And so the other thing too is a lot of our nonprofits obviously have cost reimbursement grants. And so if you're not budgeting to make money on other sources, then a lot of times the cost reimbursement grant will actually cost you more money than you're getting. So if you get a $100,000 grant, it's not uncommon for your actual expenses to be around 110 for that grant project. And so automatically out the door, you're losing $10,000. You're gonna have to make it up somewhere. And so making sure that you're kind of budgeting along the way for some excess is going to kind of help you not get yourself in a problem. And so the other point there is the budget should be done at a grant level and an overall level. And so as far as the grant level goes, that kind of goes back to that theory I was just talking about with making sure that each grant has a good budget, and that you feel good about what you're going to spend per grant, and then in other areas. And then the overall is for the organization as a whole. All right, so going on a little bit, some other budgeting frequently asked questions. Can the budget be amended? Answer is absolutely, and it should. So just like in your personal kind of financial world, I mean, I know I set up a budget for myself monthly, and I kind of monitor where that kind of goes. You want to be doing the same thing with your overall organization. So not that you have to amend it monthly, but as things change throughout the year, the board should be aware and decide, hey, things have changed significantly from when we did this original budget. Maybe it's time to amend it and make a plan for where we are at that time. So I'll highly recommend to do those amendments, amend the budget. That way you're monitoring your overall finances of the organization as a whole throughout the year. Another weird question we usually get for budgets is, do we budget for depreciation? And it kind of goes along with the next to last bullet point. Do we budget on an accrual or a cash basis? So without getting too accountant-y or debit and credit-y, we usually recommend that our nonprofits budget on a cash basis. It just makes things a little bit easier. If you don't, and you do it on an accrual basis, that there's nothing wrong with that. It's just we think it makes a little more sense for a budget to say, hey, here's the grant revenues we think we're going to get in the year. Here's where we're going to spend it. And then here's the equipment that we need to purchase if there's anything like that. We just say, hey, budget for that on an overall cash basis. We think just makes it a little easier to kind of see where you guys are kind of at with everything. That's pretty common practice across nonprofits. But like I said, there's nothing wrong with doing it. We just know that things like depreciation are a non-cash item. And so a lot of times the budgets are focused on a cash basis and kind of where things stand on a cash basis. So along that same line, if your organization has like debt, you want to usually we'd say recommend, hey, go ahead and budget the principal and interest expense in the budget, even though normally the principal payment on that debt would be a decrease in debt, not an expense. But we just think for the budget, it makes it a little bit easier to kind of do it that way. So that's probably a little technical, but what do you guys think about that? Any thoughts on that? The other one is who should vote on the budget, and that answer is very simple. So it's the board. The buck stops with the board, so the board should definitely be the ones voting on the budget and making sure that they are approving that. All right, so once you kind of have the budget set in place, your financial policies are in place, things like that. Now we kind of go into a discussion about how do you know if something's going wrong with the organization as a whole. And so to know if something's going wrong with the organization as a whole, we talk about financial red flags. And so if I'm on a board, these are things that you absolutely should be looking for and be aware of, and would be major red flags that you'd want to talk with your executive director about, maybe the CFO about, whoever is in the organization that is almost like reporting to the board. You'd want to talk about that. So is the organization losing money year after year after year? Because the organization can't lose money year after year after year if it wants to continue to exist. And so if we got to think about that, if the organization is losing money year after year after year, we probably need to look at what the causes of that are and how we can remediate that to make sure that that doesn't happen. We always say, like, losing money for 1, even 2 years is not probably the end of the world unless it's like some major, loss that's wiping out everything. But if you do this year after year after year, eventually you're gonna have no cash left, and so you're gonna, be in a place of hurt. If there are, and this is another thing, is, as a board, you should be asking probably once a year for, hey, have the 990s been filed? Are we on top of our payroll tax returns? All these things. The board really should be making sure that they're monitoring for that. So if you see that, like, there's a late payroll or sales tax deposit, it's probably a red flag that something's not getting filed timely with your payroll tax returns, and that can be a major problem with the IRS. So if you feel like that's not happening or things are going wrong there, it's definitely something to get with your accounting department or with your, if you're using outsourced accounting, with your CPA, with things like that, to make sure you don't have a problem there. Management says things are better than what the financial statements reflect. So the numbers are what the numbers are. So if you're getting like a rosy picture on something that doesn't make sense, it's probably a good time to like ask questions and make sure you're really comfortable with what you're being told. So as a board, I'd say make sure that you're kind of on top of that. This is a big one, and we see this actually. If you look in, it says concentrations from one grantor or contributor. So say you're in just to use round numbers, say you're in an organization who has $1 million budget, and $600,000 is coming from one person. That is a major contribution. So that means if that contribution or source of revenue were to stop, then you've just lost 60% of your overall budget, and now you have to fill that hole. It's not bad to have concentrations, but it's just making sure you monitor them and figuring out what the plan is if that were to go away. And if you don't know if you have a concentration, this is a little bit of a trick. But in most financial statements, there is a requirement to put a concentrations note disclosure in there. So if you're, whoever you're using to prepare your financial statements annually, if they're audited or reviewed or compiled, whatever the case may be, there is supposed to be a concentration zone in there. So that could be one place you could look to see if you do have a concentration in revenue sources. We put them in some of the nonprofits that we audit who have concentrations. So just kind of a tip or trick there. So this is like a big one lately. But if you're having high turnover in the accounting department, that could be a red flag, because that high turnover is going to lead to most likely things not working well as far as the overall finances of the organization go in general. So it takes a lot of expertise, obviously, to be able to prepare everything in the accounting system well. And so if you keep having turnover in that department, it's just going to damper those processes. All right, so some more red flags. These are things we've seen. They make it on this list because there's things we've seen over time. So the board is unable to speak with the CFO, and all conversations must go through the ED. So the board should have access to definitely the CFO. I mean, that would be a thing. And so obviously the ED is like directly reporting to the board as far as the organizational structure, but there shouldn't be like this wall built between the board and the CFO. So just kind of something to keep in mind if that's happening. It's definitely, we want to have open lines of communication across all parties to make sure that we're all working as a team for the organization as a whole. We already talked about accounts payable growing each month, but if that's something you see, that is definitely a financial red flag. And then, oh, my favorite, financial statements from an Excel spreadsheet and not the accounting software. So are we manually preparing things on a spreadsheet and we don't use basic accounting software like QuickBooks, MIP, Sage, that kind of stuff? If your organization is using is preparing things from an Excel spreadsheet, it's a great time to get with the 21st century and really work with your accountant or whoever it is and try to bring that up to speed and things like that. Like I know a lot of accounting firms can help in that area. Not just ours, but pretty much every one of them can. There's a lot in town that can do it too. That can help you get your stuff into QuickBooks if you're smaller or mid-sized organization, and that kind of stuff. Delayed audit reports, and so to defend the auditor here, which is me, a lot of times like, oh, the audit is late. It must be the auditor's fault, I guess. But a lot of times what happens is that's the things that cause the audit to be late are things like when you kind of get out to the audit and like none of the support is available. There's a lot of cleanup required in the books and so on and so forth. So when that kind of stuff happens, it usually kind of slows down the audit process because we as auditors kind of have to come in and start doing other things to kind of help the process along. And so if you're having delayed audit reports, is a good sign that something, structure wise isn't going well. Although it could be the accounting firm who you've hired to do the audit. I mean, that's definitely possible. So not to fully pull that as not a possibility, but it's a good, if you're having those delayed audit reports, it's always a good idea to start asking questions and figure out what the real cause is. That way you can start to kind of address that and make sure there's not a bigger issue. So I mentioned this one a little bit earlier too, but we also want to make sure that we are not giving information to the board last minute. That's never good. I see this too. We've seen a line of credits be tapped out at organizations. So the best time to get a line of credit is when you don't need one. So if you're in an organization right now and you do not have a line of credit, the recommendation is get a line of credit because maybe you don't need it. But when you do need it, you may not be able to get it because you need it, right? You may be hurting financially at that point and other things. A line of credit is a great way to help with like some of those grant reimbursements, like some of those cost reimbursement grants if you have cash flow needs while you're building up those reserves. That's a great way to kind of do it in the meantime. Obviously not paying your credit cards off is another red flag. So if you see that as a board, and the other thing on credit cards too is the board really should be approving the executive directors, the board chair rather, and the board itself should be approving the executive directors' expense reports, including their credit cards. So if you don't have that as a financial policy, I would highly recommend that the board approves the executive directors' expense reports, just to make sure that really it's keeping the executive director safe and it's keeping the board safe. So it's giving the executive director kind of another measure of not only accountability, but protection against himself, against anybody claiming that he or she has done something wrong. So if you can go ahead and have the executive director just say, here's my expense report. It doesn't mean it has to be approved before it's paid to them, but it's almost like a measure of, hey, here's what was paid to the executive director for their expenses. And we're just asking the board to kind of review that and make sure that there was nothing wrong with that kind of thing. So just another measure of accountability there if you want to add that in. And then, of course, if the board is asking questions and not getting good responses or vague responses, that is another red flag. So I want to make sure that's not happening.
Ben, we have one question in the chat.
All right.
An organization hasn't had their first audit yet, but they're planning on doing it soon. How much staff time should that organization budget for it?
So staff time, probably pretty significant. So I don't know how many hours to say. I've actually never been on that side of it, right? So that's actually probably not fair for me to say how much staff time it's going to take, but I would imagine it's pretty significant because the things that you're going to have to gather are, all your bank statements. You're gonna have to make sure that all your invoices are in proper order, and not only mention all your books are in proper order, and making sure all the balance sheet is recorded correctly. So it is a substantial amount of time that it takes to kind of get all that in proper order. So the more you can kind of have everything cleaned up before it gets to the audit, the more timely and the more cost effective the audit's going to be. So the worst thing that you don't want to happen is for you to hire a CPA firm, and then they come in and do the audit, and maybe you engage them, just making up numbers, but say the CPA firm is engaged with you for $15,000 or $20,000 for the audit. All right, maybe it's more depending on how complex it is. Who knows? But then they come in there and everything's kind of out of order, and it takes a lot longer than they wanted, and it drags out, and so on and so forth. And then the CPA firm comes back to you and says, "Hey, instead of it costing 15 or 20, now it's going to cost 25 or 30." So now the price goes up because everything kind of went out of control, and it's out of the scope of what originally happened. So that can happen. I mean, it's not, nobody likes for that to happen, and I think that's kind of frustrating on all parties when that does happen. But I'd say to kind of get prepared and to keep that from happening, it does take a lot of front end work on that respect. Other things up here. So in an audit, if you get an audit, there will be a page that has an area for findings if there are any. One kind of saying we have around the firm here is it's not the number of findings you get, it's what you do with them. So if I get if it's our first time ever having an audit and we get 5 findings, that would be a lot of findings. Let's say we get 5, it goes really bad, and we have 5 findings, it happens. Well, the next year we have 1. Well, we've just went from 5 to 1, and like that to me as a board, I'm very happy with that. And the next year we have 0 after that. So I always say, if you have findings and they're not getting corrected, that's probably when we want to start looking at kind of what's going on and how to remediate that, because you really should be trying to remediate whatever findings or comments you have within an audit.
Ben, when
Yeah.
when you say finding for the non-accountants in this Zoom, which is all of us other than you probably,
Yeah.
Can you kind of stack the tier of material weakness versus significant deficiency versus finding overall? Like, are those first two you consider that? Obviously, those are findings, but elaborate a little bit on that scale.
Yeah, and so to be super technical with you and to confuse you more, in our jargon, we call it a management letter comment. So there's different levels of kind of what you're talking about where there are findings. The worst, the most serious finding is what we call material weakness. And so if in your audit, your auditor comes to you and says, "Hey, we have a material weakness in an area," what that means is there's a chance that because there's a lack of internal control in some area, or something's not happening correctly, that there's a chance that the financial statements at some point could be materially misstated because there's a lack of controls. A significant deficiency is like the next level down, and it says, "Hey, it doesn't quite rise to that level of material weakness. It is still a finding. It's still going to go in your audit and your public financial statements most likely, but it doesn't quite rise to the level, but it's still very serious." And then there's kind of a level down from that where it doesn't really go in your statements. And sometimes we'll do that. We put it in writing. We write a management letter to the board, and we still say, "Hey, not going in your public financial statements or anything like that, but in our management letter, we just wanted to note to you X, Y, Z." And that's actually another area where it's sometimes we'll put recommendations to the board as well in writing. And so those are sometimes good comments too. So not every audit comment we have is bad. Sometimes we'll put like written recommendations down. I saw one, I think earlier today, where we did a presentation and the organization had a significant amount of cash on hand. And our recommendation was, "Hey, that's sitting in a checking account. Interest rates are high right now. We should probably move that and do something with it." So there's sometimes good comments as well, just to kind of paint the picture there.
Thank you.
Yeah, thanks for asking. All right, so we have about 15 more minutes. So we'll talk about this real quick, and then I'll go to some financial statements, and then I'll save like 5 minutes or so for questions if anybody has any. So internal control limitations. So things to keep in mind here is even if you have really good internal controls, sometimes it's too costly to put all the control measures you need to in place to minimize fraud. So with the internal control, there is a cost benefit analysis to do to say, "Hey, We want to have our controls as strong as possible to eliminate the possibility that someone will override them and, or there will be a fraud. But if those controls are overridden, there is always that kind of risk that somebody's just going to kind of blast through the rules and kind of override the controls, or that two people will collude. Those things are always there. So you want to make sure that your policies are sound, but that they are not like hampering the organization from being able to carry out what it needs to carry out. So that's a very gray area. But just something to remember is there are limitations to internal controls. That doesn't mean they're not important. It's just something to consider when you're kind of creating them. All right. So to go on a minute here, we're going to talk about a few different financial statements. I'm going to skip forward a little bit. This is a little bit of a chart that kind of shows all the different financial statements for nonprofits. And so for this, it's kind of a reminder that the statement of financial position there on the left, that's at a point in time. So when you're getting that report that says it's your statement of financial position, it's your balance sheet, that is as of a certain date. The statement of activities, cash flows, and functional expenses are all over a period of time. And so that's a very good distinction to make and something to remember as you're looking at these reports to say, hey, so 3 of these reports are over a period of time. This other one is as of a point in time. And so it provides basically different information, but they all kind of go together in that realm. Obviously, statement of financial position is the basic accounting equation here. Assets equals liabilities plus net assets. Net assets being equity for the nonprofit. So when you're looking at that, it's everything you own minus what you owe, and then what's left over is kind of the way I think about it. So what's normally included in the statement of financial position? That's going to be things like cash, CDs, prepaids, and so on and so forth. Here, some nonprofits have inventory. If they have like a thrift store, that's pretty common. So sometimes you can see inventory on a nonprofit as well. Liabilities on the statement of financial position, those would be things like accounts payable, accrued expenses. Sometimes organizations have deferred revenue or refundable advances, as they're sometimes called. And then long-term debt is another one. So those would be some of the liabilities that you're probably used to seeing. All right, so this changed about, I think, 5 or 6 years ago, if I remember correctly, maybe a little sooner than that. But this is on the statement of financial position, you're going to have obviously net assets. And so the thing to remember is the net assets is right. It's your assets minus your liabilities. It's what's left over. And so your net assets are what people call your reserves. And those reserves can, if you have like overall net assets, those can be with or without donor restrictions. If a donor has restricted how that money can be used and externally, and they say, hey, you can only use the money I've given you for XYZ purpose, the money is restricted and it can only be used for that purpose. If it's without donor restrictions, the money is free and clear to use for whatever the organization needs. And the other thing to know too is a lot of times I see nonprofits get focused on thinking, oh, I have $10,000 in the bank. That's how much money I have to use. That's my reserve. Is my $10,000 is my reserve. No, your $10,000 is what's sitting in a cash account because you forgot that you have $20,000 of payables sitting in there. So you actually have a negative $10,000 in reserves, right? So don't get too focused on what's in the cash balance of your bank. While that is an important thing to know and to be monitoring, your reserve balance is far different than what is sitting in your bank account. And so making sure that there's a conceptual understanding of that is pretty important for making decisions. All right, so the statement of activities, that's the fancy way of saying an income statement, a profit and loss statement for your organization. So probably not too much to point out here. I think most people are used to seeing kind of a profit and loss statement. The thing to keep in mind is, like I said before, this is a statement that shows activity over a period of time. And so you're seeing something of a period of time versus a point in time. So they kind of go hand in hand together with the balance sheet, if you want to think of it that way. So here's some of the different types of revenue sources in the statement of activities. You're going to have contributions, program services revenue, governmental grants are obviously some of the most common ones. And then you have special events revenue and investment income, which includes things like interest income. And then I'll say too, when you're looking at your statement of activities, especially the reports you're providing to your board, it's important to look at that and make sure you feel good about how the stuff's being coded there in the income statement and the revenue area specifically, to make sure that gives you a good picture as far as where your revenue sources are coming from, because that's basically just you're able to use that to communicate to the board as far as how you're doing. And then expenses and the statement of activities, if you look at your statements, maybe during the audit or otherwise, those are going to be in two main functional categories. Those are program expenses and supporting expenses. Supporting expenses will be things like admin expenses, and then usually as well, like fundraising and things like that would be in those kind of two areas. All right, we're going to skip this because I think we're out of time for a cash flow statement, but just keep in mind, there also is a cash flow statement in your financial statements. It does give a lot of good information. It has things in like different categories and things like that. But I think getting kind of comfortable with all the other reports first and then going to your cash flow is good. The main thing I tell people with cash flow statement is that if you're looking at your operating activities, we really want that number to be positive, because that shows you that the organization is using their cash for operating kind of purposes. If you have a negative operating activity, that means that something's kind of happening in the overall just normal everyday kind of scenario with the cash that it's causing it to go negative. So it's just kind of something to look into and figure out kind of what's going on there. So hopefully you guys are familiar with what these look like. We just have some pictures in the slides to kind of show you some different statements. So this is what a statement of financial position looks like on the top with your total assets. Your liabilities and net assets look like this down here, with the net assets being broken down into those kind of with and without donor restrictions. And then there's a statement of activities here, again, with and without donor restrictions. We have them kind of put in columns here. And if I, what I can do after this is I can send these slides to Justin if he wants to send them out to everybody on the call today. That's fine with me. Functional expense statement here is going to be also in your annual financial statements, and that's going to have all your expenses in those two big categories, but then it also breaks them down by what we call the natural class. And so that's going to be like rent or contract services or things like that. It's going to have all your different areas down here. And then to go forward a little bit more is the cash flow statement, has those categories, like I said before, with investing and financing and operating. And then I'm going to go back to the last slide, because I think the last slide is super important. So passing baton. So right now we're seeing a very, very, very high level of turnover in our nonprofits, both in the executive director position and in the CFO position, specifically in the CFO position. So the thing to know is accounting enrollment is down nationwide. You can Google articles about it, and you'll just read article after article after article where people are not entering accounting school like they used to. So the amount of people leaving the profession right now, there is no replacement for them. We're not as much nationwide. So we definitely have like a period of time in the next 10 or 15 years within the United States where there's definitely a lot of struggle, I think, in the accounting area. So making sure that you're kind of trying to prepare for that as best as possible. And if you do have somebody nearing retirement, especially in the finance department, doing everything you can to get ahead of the situation and figure out a replacement for them will set you up for success. We've seen good examples of that in our practice, where we've seen organizations bring somebody in well ahead of time, and even have some overlap there where they're able to work with the current finance director, and then then the finance director retires or whatever. The more you can kind of do things like that and kind of work in tandem and kind of set yourself up for success is going to help you in the long run immensely. So there's kind of things to keep in mind there. But without that, does anybody have like any more questions or anything else I can answer before we kind of sign off for the day?
I do have one question. how should organizations, going back to your last slide, how should organizations prepare within succession planning? Since you talked about the decline in the sector when it comes to accounting, um, let's say that their account manager or their auditor, like you, retires. How does that succession planning play a role within the company, i.e., like James Moore, and passing that off or that baton off to the next person that would take in or take over for that spot?
So can you say that in a different way? So you're saying, what if there's a succession within the auditor, or what are you saying?
Yes, a succession within the auditor, and keeping that relationship as it passes off.
That can happen too. So sometimes, like, I mean, obviously auditors do retire, right? And so, I mean, I think the same principle applies, but hopefully, if you're with an accounting firm, the nice thing about being with an accounting firm as opposed to like a sole proprietor, right? Like a one person kind of deal, which usually auditing firms are not one person deals. They're usually an accounting firm. The nice thing about being with a firm is it's a team. And so, like at James Moore, when one of our partners retires or anything like that, we always make sure that there's kind of succession built into place, and that the clients know who the new partner is, or who the new, or if it's the manager kind of taking over. Like, we make sure that they're all comfortable with that. So if you do have like a firm who has a partner retiring, or your partner on maybe your engagement's retiring, yeah, you can reach out to them and make sure that you're comfortable with kind of the plan in place, and that they're that you feel good about everything from that standpoint. But yeah, I hope that answers that.
Absolutely.
Ben, do you have a rule of thumb on how often you should change auditors?
That's a good question. I answered that question however I need, right? Because it can, there can be different answers to that. I think I actually don't, and this is probably going to sound self enticing. I actually don't really super love changing auditors. So the reason I say that is it's actually pretty costly to change auditors. So I just recommend that the auditor that you're using, you have a really good relationship with, and you feel really comfortable with, that they're giving you the best service they can and getting you all the information they can, and that they're doing a quality audit. So what we're seeing more so is that there's some firms that maybe don't do as much of a quality audit. So really getting comfortable with the information that your auditor is asking, make sure they're asking for kind of everything. But it does take a new auditor some time to begin to understand your organization as a whole. And so I think what's more important than like an audit rotation rule or things like this are to make sure that you feel like your auditor is going as deep as they need to understand everything they need to about the organization when they're kind of performing the audit. So I don't know if that answers it, but I don't think there's a rule of thumb. I mean, there are some organizations like workforce boards, for instance, who have like a mandatory partner rotation rule. I think that's, out of all the things I've seen over the years, making like you rotate from like one firm to another, I think just kind of, it's a little bit disjointing for the management. But I do kind of like the idea of a partner rotation within the accounting firm itself, especially if you're with a firm who's big enough to rotate partners. Because we've done that a lot with our workforce boards, where every 5 years they make them kind of switch from one partner to the other. And then the new partner coming in, not only you get to meet somebody new at the firm, but they also come in with different kinds of questions and perspectives. So you get to kind of see different things from that kind of point of view.
Alrighty, seeing no more questions, we want to thank Ben Clark of James Moore for offering this amazing presentation to you all, our UPHS members, and thank you for your time as well, and giving us an hour of your subject matter expertise and being able to share that information. The only announcement that I have is we are excited about our 25th annual conference and conference for excellence in nonprofit management and leadership. This is our 25th year of the conference, 20th year of UPHS being in existence. So we're really, really excited for that. Those dates again are May 7th and 8th at the Florida State University Student Union. The 7th will be our 20th year celebration and human service award night event that will be happening and starting at about 5 o'clock in the evening on that Tuesday night. And then that Wednesday morning will be the start of our full conference day with professional development workshops. Our schedule is available on our website at uphsfl.org. But without any more comments or questions from the membership or from our audience here today, we thank you all again for coming to another United Partners for Human Services workshop. We hope you have a great rest of your afternoon and a great rest of your week.
Thank you.
Thank you.
Thanks, guys.